Industry Experts Panel at PortfolioWealthGlobal.com. My name is Michelle Holliday. Today we have a great show lined up for you. In preparation for today's show, Portfolio Wealth Global actually reached out to a number of our affiliates and peers, asking them to email in their most important questions for today's guest. Our guest is Mr. John Rubino. We actually received a huge amount of questions, and John will be very relieved to know we only chose the top 10. John is the founder of dollarcollapse.com. He is also a former Wall Street analyst and a very well-known financial broker. John, welcome to the show. How are you today?
Great, Michelle. Good to talk to you.
Oh, we're thrilled to have you. John, we're going to start off with our very first question. It comes from one of the closest confidants of Tom Beck. He's the founder of Portfolio Wealth Global. And one of the reasons that we put this question at the top is that it actually is the most popular question that everybody asked. He puts the question like this. He says, has 2008 and the aftermath of it with the TARP bailouts, QE program, and ZIRP policies actually solidified how much the world, governments and citizens alike, are locked in and accustomed to fiat currencies and our current systems? In other words, if 2008 did not change the public's perception of currencies and only being backed by good faith, what would?
Well, what happened after 2008, 2009, and by the way, I didn't think this was possible. I thought that was really the end of the road for this financial system. But we basically borrowed more in 5 or 6 years than the human race had borrowed up until that point. So
wow.
Think of the world, the global financial system, as a family where one of the breadwinners loses their job. And instead of taking the kids out of private school or selling their house or downsizing in some other way, they just put it all on credit cards and keep going. Well, to the neighbors, it looks like they're fine, right? Because they've still got their big SUV in the driveway and they're still in their big house, et cetera, et cetera. But what's actually happening is they're building up so much debt that the repo man is getting ready to come and take everything away.
Wow.
So what we've done since 2008, 2009 in no way helped us. All it did was buy us a little bit more time in which to fix things when we didn't fix anything. We just continued to build up debts all around the world. And now what you're seeing is a lot of these debts that we took on in the last 5 or 6 years start to cause trouble. For instance, you've got emerging markets right now that borrowed a ton of US dollars for some reason, thinking that their currencies would continue to appreciate versus the dollar, which means it would be really easy to pay off dollar-denominated debt. Well, that's blowing up on them. You've got Venezuela, it's already completely collapsed. Argentina's in the process of collapsing. Brazil, which owes a lot of dollars externally, is paralyzed by civil unrest right now, and it can't pay its bills. So you've got that happening out there. And that's one of the things that frequently leads to a global financial crisis, when something at the periphery of the system blows up. That causes dominoes to fall, which leads to the core of the periphery or to the core of the system, and you get a global crisis. So that's one thing. In Europe, where they've taken on huge amounts of debt without really fixing the reason that they had to borrow all that debt. Now you've got Italy, after Greece blew up a few years ago, you've got Italy being so frustrated by the situation that their citizens find themselves within, that they've elected a set of populists who don't want to be in the Eurozone anymore. They want to go back to the lira, their old currency, which would potentially blow up the European Union and the Eurozone. China took on about 5 times more debt coming out of the 2008-2009 crisis. So now they're one of the most heavily leveraged countries in the world, and a lot of that debt is US dollars.
Oh, my God.
So you've got the US dollar going up right now because of global turmoil. You know, people tend to jump back into the dollar when they're worried about the rest of the world, and that's making it harder for China to pay their external bills. So if you look around the world right now, you see the very predictable results of borrowing huge amounts of new money on top of a bunch of old money. And that is, a lot of this debt is going bad. So the question is, from here, where do we go? Do we have a garden variety recession Or do we have something a lot more serious? And I would argue that the numbers are so huge now that what comes next is potentially a lot more serious than 2008, 2009 was, which that was a near-death experience for the global financial system. So this time around, we could easily see the dissolution of the whole concept of fiat currencies and the edifice of debt that has been built up pretty much everywhere in the world. And so the question then becomes, how does this happen? You know, does this happen through default, where everybody goes bankrupt and just can't pay their debts anymore, and the debt is wiped out by people refusing to pay their debts or being unable to pay their bills? Or does it happen through inflation, where we say, all right, if we devalue all our currencies by 50%, let's say, then maybe we can cover our debts. And that's what we're probably going to do. We'll do, on some weekend when all the markets are closed, we will announce a global currency reset in which the major currencies of the world still exist, but they become backed by gold, with gold at, let's say, $10,000 an ounce, which is a huge decrease in the purchasing power of all the people who own those currencies. But it puts us back on a potentially sustainable path. That's going to be traumatic for pretty much anybody who trusts their government and keeps their savings in the local fiat currency. But it's going to be great for people who own real assets, which will tend to go up in value relative to these currencies. So what we'll see is a huge shift from paper wealth, in other words, dollars and euros and yen, and the bonds that are based on them, to real wealth, which is gold, silver, energy assets, well-chosen real estate, stuff like that. And
back to reality, right?
Back to reality. Yeah, this has been a really strange experiment starting in 1971, where we took all the world's currencies off their remaining link to gold. And since that time, we basically handed the world's governments unlimited credit cards because they could create as much new currency as they wanted to, because their currencies weren't linked to anything. Their currencies were just make-believe. And so, yeah, it has been a fantasy. And in some ways, it's been a really pleasant fantasy for people who own assets like houses or stocks that have just gone up in value year after year after year. But what was really happening was we were devaluing the unit of measurement. We were changing the measuring stick. And so these things went up, but it was really the dollar and the euro and the yen and the Chinese yuan that were going down in value. That's not the kind of thing that you can sustain indefinitely. And the end appears to be imminent.
Now.
It's going to happen pretty soon.
The end is here.
Yeah.
Oh my God. Okay. Next question. Following up on the first question, John. The second question goes like this. There is an open issue remaining currently of whether or not our financial situation right now is even more dangerous and fragile than it was before the 2008 crash, as the central banks have now extended the boundaries of what they once thought was not even possible. What is your perspective on our current situation? I think you touched on that, but this is the second question.
Yeah, it's vastly more dangerous today than it was in 2008, let's say, because we've doubled the amount of debt that we've taken on. And it's not just official debt. There's something called unfunded liabilities, which are the promises that are made by governments and by pension funds around the world to people who might someday benefit from a plan like Social Security or Medicare or a public sector pension. Those things don't count in the official deficit statistics, for instance, for governments, but they're real obligations. You know, we're not going to stiff baby boomers on their health care because that would be politically impossible. My generation would not put up with this, and we would vote whoever tried to do it out of office. So those are just as real as government bonds or corporate bonds or mortgages or credit cards, and they're ballooning. So if you include those in our debt calculations, you get debt levels that are insanely high and completely unsustainable. So yeah, the danger now is vastly greater than it was back then, just because the actual numbers, when calculated honestly, have doubled or tripled from those days.
That's incredible. Question number 3. By the year 2025, the domestic product, the gross domestic product of China, is on track to likely surpass that of the United States. This would make China the world's #1 economy. American dominance is in technology and still visible, but by 2035, if all things hold true, China will spend more on defense, technology, military than the U.S., making it not only the largest economy, but also the strongest militarized nation. What are some of the ramifications of this, and how can everyone and what can they do to prepare for this possibility?
Well, there are two parts to that story. One is, the U.S. is just 5% of the world's population. So the idea that we're going to dominate the world for the next 100 years doesn't really make any sense. The only way we could do that is if we kept everybody else poor and ineffectual. In other words, keep China a developing nation rather than a developed one. Keep Africa dirt poor the way it is now. Keep Latin America in chaos. Keep India in chaos. That's not a good way to proceed in the world, because then we may be the world's only superpower, but the world that we're presiding over is a nightmare. What is a lot more likely is that the other countries of the world will over time continue to develop. They'll catch up to us. And so the U.S. will be a strong player on a good team. That's the ideal for us. We don't want to dominate, or we shouldn't want to dominate the world into the indefinite future. We should want to lift the world up so that everybody else is fairly rich and capable of having good lives and is oriented towards peace, not war, and order, not chaos. So if we continue along this track without any big disruptions, you would expect China, which is 1/4 of the world's population, to be the most consequential country. That's just the way it's going to play out. We don't have a choice as 5% of the world's population to continue to dominate the world. However, it's not going to play out that way because we have this gigantic financial crisis looming in the not too distant future where we've all borrowed so much money that's going to cause this huge disruption. And that is inherently unpredictable. You just don't know how a financial crisis is going to go. If it's going to extend into geopolitics and cause some kind of a big war, or lead a lot of these countries who are so over indebted now that they just can't function to adopt dictatorships of some sort. That's historically how it's gone. After the French Revolution and their hyperinflation in the 1780s, you got Napoleon and a whole generation of European wars. After the German hyperinflation in the 1920s, you got the Nazis and World War II. So all the debts that we've taken on is this wild card in what would otherwise be a fairly predictable progression of the world getting better and more sophisticated and richer and freer, and so it's really hard to predict how this goes.
So it's not a given.
Nothing is a given. No, nothing is a given at this point because we have to get through a big financial crisis along the way to all of this other stuff playing out. And big financial crises are inherently unpredictable.
And just scary and exciting at the same time in its own way, because there is money to be made.
Exactly. The optimistic side of this is that it's an investment thesis. If you see chaos coming, then you bet on stuff that benefit from chaos. And that's basically the precious metal story right there in a nutshell.
Wonderful. Now, John, next question. It's important because this question, we actually received several different variations of it, and so many people seem to be puzzled by the essence of this question. Has the United States dollar really collapsed by 97% since 1913? Is life that much more expensive right now in the U.S. due to inflation? Because wages have also increased a lot to balance this out. So the standard of living seems to be pretty good in the United States, especially in comparison to much of the rest of the world.
Well, yeah, the early stages of currency inflation, and I would date the plunge in the value of the U.S. dollar relative to life's necessities from 1971, when we took the dollar off the last vestiges of the gold standard. And since that time, gasoline and bread and milk and houses, et cetera, have all gotten more expensive. But you're right that wages have gone up commensurately. So basically all we've been doing is changing the way we measure stuff in the world, or we measure your wages or the things you have to buy with your wages. And they've all been distorted by this, but they've all gone up. So it looks on the surface like it's possible to run an inflationary regime. In other words, to devalue your currency a little bit each year and get away with it forever. But what also happens in that kind of a process is that it encourages people to take on more debt, because if you think the dollar is going to be worth less 5 years from now or 10 years from now, it's kind of smart to borrow money, right? Because you're paying your interest and then your principal back in depreciating currency, which makes the loan a lot better deal than it seems otherwise. So you get a world in which everybody has this attitude that, well, I don't have the money to buy this right now, so let me borrow. And you get a world in which everybody's taking on more and more debt until that debt becomes the defining feature of the system in a bad way, until it blows up on you.
Right. Until you just can't do it anymore.
Well, yeah, you can live beautifully. Again, back to the family analogy. You can live a really nice life for quite a while by, whenever there's a credit card offer in your mailbox, you take it, and then you max out the credit card, and then you move on to the next card, and then you take out a mortgage and a car loan and student loans, and you get all the stuff that you want. But at the end of the process, you have this mountain of debt that ends up taking away all the things that you thought you owned. And the world is in that kind of a situation right now, where the amount of debt that we owe is so much greater than our ability to generate wealth to service that debt, that it has to mathematically blow up on us at some point in the not too distant future. And then we'll look back and we'll think, oh, that didn't work at all. We tried, I
gotta learn how to use the credit card.
When inflation was 2 or 3% a year and our wages were going up at 2 or 3% a year, that seemed okay. But now inflation is heading towards infinity and our wages are not keeping up. And our life is a mess, and that's the situation that a lot of people are going to find themselves in when currencies stop working the way they work today.
And there's just going to be a catalyst, right? There's going to be just something that happens, and then the whole thing just...
Well, see, that's actually a question that should have been on your list if it's not. What is the catalyst?
What is the catalyst?
Yeah, what's the straw that breaks the camel's back? Yeah,
right.
We've created conditions in which there are 20 or 30 out there that could all do it. And so there's no way to know. Jim Rickards, who is a best-selling author and just a general stud in this space, the gloom and doom economic space, has an analogy of a mountainside where it's been snowing and snowing and snowing. And the snowbank there on the side of the mountain is ready for an avalanche. It's ready to crack and go down the hill and wipe out the village at the base of the mountain. But you can't know what snowflake is going to cause it. But at some point, one snowflake is going to hit, and that's going to be the immediate cause of the avalanche. But it's not the real cause. The real cause is the fact that it's been snowing for such a long time and so much snow has built up. So it's the same thing with catalysts in a financial crisis. You create the conditions for a really bad thing to happen, and then something comes along to set it off. But it wasn't that thing. It won't be Italy that actually causes the global financial crisis, or a war in the Middle East, or a spike in oil prices, et cetera, et cetera. Those things will just be the thing that sets off the chain reaction that was going to happen regardless. Because if it wasn't Italy, it would be oil prices or something. Yeah.
Okay, John, next question. We go to precious metals. Has gold lost its precious metals premium to production cost, basically? And same question for gold.
Premium to production. In other words, are precious metals trading at a level that most gold miners can't make any money? Because
exactly.
It's down there. I think the production costs for both gold and silver are a little below today's prices, but not much. And that historically tends to put a floor under precious metals prices, because once you get to the point where what a gold miner can sell their gold for is less than what it costs to get it out of the ground, they just shut down. They go to care and maintenance on their least economic mines, and you see the supply start to dry up. And historically, this has been the point at which the price starts to turn around and go up again. And that's true for all commodities. You have these cycles where the price will drop to the point where people just start shutting down and supply dries up and then prices rise. We're not far from there. And that should give people who own gold and silver confidence to stay the course as we grind through this boring time when it's not really doing much of anything.
Right.
Because the downside risk is very limited and the upside potential is really outrageous in this world.
Huge.
There are very credible calculations of the amount of precious metals in the world versus the amount of paper currency in the world that puts a legitimate price for gold at $10,000 an ounce. In other words, that's where it will go when everything hits the fan here.
Wow.
And so you don't want to miss that. If you've been in gold for a few years.
That would be awesome.
Yeah. I mean, the kind of world in which silver is $100 an ounce and gold is $10,000 an ounce, it's a messy world. So it may not be the most pleasant place to live, but the fact that you have this asset that went way up in value gives you a chance to get through it. It makes the world better than it would be otherwise. And that's really all we can hope for heading into something that promises to be extremely messy and extremely scary, is that some of our capital is preserved and allows us to buy life's necessities and protect ourselves and maybe invest in things that at the bottom of the cycle are really attractive. Right,
because the opportunities are going to all of a sudden spring up everywhere.
Oh yeah. My next book that I should be working on right now, but I'm procrastinating on, is about that. It's the working title is After the Crash. And the premise is that, a big financial crisis is coming. But you already know that because it's been coming for 15 years and you've read some of the books, blah, blah, blah. But what happens at the bottom of the next crisis? Well, there's going to be some amazing growth stocks because there are so many technologies that are bubbling up right now that are really astounding. Solar power, regenerative medicine, all kinds of other alternative energies, all kinds of other healthcare and agriculture things are going to be the growth stocks of the next cycle. And they'll be incredibly cheap at the bottom. So learn about them now and be prepared to jump in with both feet when the time comes.
Awesome. Now, John, next question. In your opinion, do you believe that cryptocurrencies are better than fiat currencies? And if you do, in what way?
Well, I love the concept of cryptocurrencies. This is private sector money that is independent of any national government, can't be inflated away by those governments. And because of that, might hold its value when fiat currencies are falling apart. But there are a lot of moving parts of the cryptocurrency story, and I'm not really sure how it all plays out, because on the one hand, if they become a threat to governments are going to attack them in some way. And it's not clear whether governments have the power to wipe out fiat currencies, but it's not clear they don't either. So we're going to see how that plays out, where regulations get more and more onerous, and fiat currency traders have to route around regulations in one country to be able to trade in another country. And in some places, they might just flat out make them illegal. I mean, they made gold illegal in the 1930s in the US. So there's no reason why they couldn't, if they feel threatened, make Bitcoin illegal. So it's not clear how it all plays out. But I'm watching with interest. I love the concept. And I'm rooting for fiat currencies to have a big role in the future monetary system.
Me too. Okay, now, John, this is something that you touched on just a little bit ago. Our next question. In light of what is being predicted for the U.S. dollar, should people be borrowing money right now in order to pay back depreciated dollars in the future?
That is a really important question, because you're right. That's the logical conclusion that you come to when someone says, "Oh, the currency is going to evaporate." Well, borrow a bunch and then pay it back in evaporated currency. That's a great deal. And inflations historically have been really good for borrowers. You know, if you're deeply in debt and the currency goes down by 20, 30, 40, 50%, the real cost of your debts have gone down by that much. So on the one hand, that's a logical thing to do. On the other, it's incredibly dangerous for a couple of reasons. One is that you've got to be able to make your payments in the meantime. If you borrow a lot of money and those payments bankrupt you, then those debts, you know, the debt is wiped out, but you lose almost everything else you have too. So the average person should absolutely not be borrowing a ton of money based on a dollar collapse premise, because it puts the rest of their life at risk. And you also get governments reacting to stuff like this in potentially dangerous ways from the point of view of borrowers, where historically some governments have changed debt contracts, in effect index them, so that the debt becomes more onerous as the currency becomes weaker and weaker. And so you're just running in place. You know, you don't make the killing that you thought you were going to by betting against the currency by borrowing money. So, and then, you know, the other thing is you could borrow money to buy gold. Gold would go way up.
You know, that's what people are thinking.
Yeah. I mean, see, I absolutely don't want to sit here and advise people to borrow a lot of money under any circumstances, because debt is really, really dangerous. But there will probably be some people out there who make a leveraged bet at just the right time on some kind of a precious metals related thing who make a ton of money. And that's what happened, with betting against the housing market in the 2008-2009 crisis. The movie The Big Short, if you haven't seen it yet, awesome, is based on people doing something like that, where they made leveraged bets against the financial system at that time, and they made orders of magnitude more money than they started with. There's probably the potential to do something like that with precious metals, bet against the currency and on precious metals in going forward. But again, don't do this at home unless you have just rock solid financing.
John Rubino did not advise me to do that.
Yeah, please.
Okay. Yeah. Next question. Is the government out of control in terms of spending? Because it does not seem like the creditors are openly raising any eyebrows.
Well, that's one of the real surprises of the last 10 years, that we could do something like quantitative easing or having $35 trillion of negative yielding bonds in the world and not have the bond markets just totally freak out. And what I think is the explanation for that is that everybody has watched the central banks of the world create unlimited amounts of currency and use that currency to buy back financial instruments. And so the whole don't fight the Fed thing has become a global phenomenon in which whatever central banks were doing, we just bet that they'll succeed. And so far they've succeeded. But the safety valve in all this, in other words, you create pressures in one part of the economy and it has to come out somewhere, so it'll blow out somewhere else, is currency value. If you're going to continue to create currency out of thin air and use it to buy back financial instruments, at some point, the supply of currency in the world becomes debilitating. There's just so much of it that the value starts to fall. And then this central bank-led economy falls apart because they don't have the tool that they used to have, which is a solid currency with which to buy back all of these financial instruments that are out there. So they can't continue to borrow money and then just buy it right back with newly created currency. And then the system breaks down. The governments of the world have to live within their means, which they can't do. Corporations can't borrow anymore. People can't take out mortgages, et cetera, et cetera. And this credit-addicted system stops working. So it's not if, but when this is going to happen, because we're creating the conditions in which it has to happen. But we don't know whether it's this year, next year, or 10 years from now, which would be really unlikely. But the last 10 years were pretty unlikely too. So we can't know the timing of all this. But based on human nature and math, we can be reasonably sure that the end of this process is out there somewhere waiting to happen.
It's coming. Now, John, why is Russia stockpiling gold?
Well, Russia is doing that in China and India are both doing that too. So the people in the East are buying precious metals, because India is buying a lot of silver too, for a couple of reasons. One is, they get it. They see that the world's fiat currencies are actively being inflated away by local governments, and that process can't continue forever, and that the world will go back to some form of a gold standard. Or at a minimum, gold's price will go up and they'll have made a good investment. The other impetus for what they're doing is that they're frustrated with the US having the world's reserve currency, because that gives us, for instance, the power to build $1 trillion a year global military empire that restrains Russia and China and India in their own backyards. They would like to be, if not global powers, regional powers. They want to dominate their neighbors, as, historically big countries have always wanted to do. It's not this brand new thing that they discovered. It's something that powerful countries have always wanted to be able to do for their own defense, if for nothing else. If you've got political sway with your neighbors, then you have a buffer around you. You can't be invaded as easily. And, especially in Russia's situation, they've been invaded a lot. They don't want German soldiers to come across their borders again, or French soldiers or whatever, because that has happened in living memory. So they've got a point, you have to admit. And one of the ways that they hope to achieve regional dominance, or at least regional power, is by weakening the US. And if they continue to buy gold with their dollar reserves, a lot of the times they're selling dollars in order to buy gold, their currencies are going to be backed more solidly than the other currencies of the world. And at some point in the future, their currencies might be reserve currencies to an extent, giving them some of that reserve currency power. In other words, allowing them to create more of their currencies, finance a stronger military, and in that way, challenge us. And, that's normal geopolitics. It's happened since the beginning of time. And they're using money as one of the tools in this great game, as it used to be called, that is now playing out on a new stage. It's playing out on the monetary stage. But that's why it's playing out. And I would argue that, to the extent that, they're not acting brilliantly across the board, but in the monetary realm, where they're buying gold with fiat currencies, I would argue that that's a smart move for them, that will probably pay off for them in the future and give them some of what they want.
And our position as the petrodollar, man, that's really given us the trump card, if you will, for how many years? 60 years? 80 years? Something
Since
like that?
the 70s. Yeah. That's something that has allowed us to do things that we wouldn't have normally been able to do. Or again, we're 5% of the world's population, and our currency is absolutely dominant for global trade. And that gives us immense amounts of power around the world. We can threaten to cut, for instance, Iran out of the global financial system, or I think we've even threatened Russia with that. And they can't trade through banks globally if we say they can't anymore. There's something called the SWIFT system, which is a settlement system for banks moving money from one place to another. We control that. And so obviously that's frustrating for anybody who is on the receiving end of those kinds of threats.
Now here's question number 10. John, what are the top 2 actions to take if you're approaching retirement age with insufficient savings?
Well, that's 90% of the baby boomer generation right there, right? We didn't save enough as a generation, and nobody else is either, but we should have, and we didn't. And it's not an easy thing to deal with, because later in life, your expenses kind of go up. You can have healthcare bills that wipe out any kind of a savings plan that you might have had. But barring that, if you've got positive cash flow, the way to build up savings is basic common sense. You spend less and you save more, and you do it as aggressively as you can. Live small now so you can live comfortably later. And that's just the price you pay for not having saved money in the past. With the money that you're saving, you can, a regular financial planner might say, well, you can go aggressive for a few years, buy a lot of stocks, and they'll yield more and build up your capital faster. And that would have been the right thing to do over the past 10 years. But I think that stock valuations being what they are, we're near the end of that process too, although we might not be at the end. Stocks might have one more pop in the future as money flows in from the rest of the world, because the rest of the world is even messier than us. US stocks might go up. But I think shifting your finances, shifting your capital from financial assets to real assets on an ongoing basis is probably the safest thing to do. In other words, if you've got a bond fund out there, that's at risk of a currency crisis. So move some of the money from your bond fund into a precious metals fund, for instance, or physical precious metals that you're storing at home. I lean towards gold and silver as the assets that will protect you going forward. And when there is a currency reset, all of a sudden your capital will jump. And it's possible that if you've got enough gold and silver relative to fiat currency, you'll be okay at the time. You'll have saved enough and be able to retire comfortably. But I wouldn't take a lot of chances other than that, because the world is getting really choppy and really volatile. And any chance you take could just as easily blow up on you as pay off for you. So now is a dangerous time.
If they move their whatever assets bond-wise or retirement accounts into gold, that's what the best advice for them.
Well, not 100%, but start trending in that direction. As you're adding money to your account, make sure some of it goes into precious metals. Stay diversified, at least to an extent, but favor real assets, energy assets, well-chosen real estate, precious metals, over financial assets like government bonds and bank stocks, for instance. And then over time, your portfolio will be more heavily weighted towards stuff that will probably do better in a currency reset scenario, and then you'll do better then.
John, just out of curiosity, how much of the population is a baby boomer, is the baby boomer section?
I don't know. We've been the biggest cohort for most of my life, but the millennials, I think there are as many millennials now as there are baby boomers. We grew up in amazing times. I mean, when I look back on how easy everything was for me, when I was 17, you could just walk up to a factory in my hometown in Ohio and say, "Hey, I'd like to work." And they'd say, "Oh yeah, come on in." I was a member of the United Steelworkers Union at 17 and made pretty good money. And then went to finance, got a finance degree, and went to Wall Street, where headhunters were just calling daily. "Oh, do you want to work for Drexel, Burnham, Lambert? Do you want to work for Solomon Brothers?" And
wow.
That in retrospect didn't seem easy to me, because all of that was challenging, but the opportunities were there, and they're not there for you guys. If you're a millennial, you walk up to a bank or somebody else that you want to work for, and they'll say, "Oh yeah, come on in. We'll give you an unpaid internship for a year." It's a completely different thing.
Great.
And and so it's much harder for millennials, in part because of the mistakes that baby boomers made. We borrowed way too much money, and when you borrow too much money, life gets harder. But not necessarily for the people who own houses that are appreciated and who've worked at good jobs for 30 years. We're okay. We have a lot of wealth accumulated. But for the people coming along behind us, it's much, much harder, because those opportunities are gone. For a 25-year-old trying to buy a house in California, impossible. You can't do it. 50 years ago, a 25-year-old could buy a house pretty easily, pretty much anywhere, with the money that they would make just doing an entry-level job. And it's not like that anymore. So I'm sorry. On behalf of my generation, I apologize for
you owe everybody a big apology.
Yeah, and we never really had to sacrifice either, but we didn't have a World War II or anything that we had to deal with, or a depression. But it's possible that our time of sacrifice is still coming, when the system starts to break down and the government says, "Oh, you know what? Retirement age is no longer 66. I'm sorry, it's going to be 75. And so all the baby boomers have to work for an extra 10 years in order to finance the lives of our kids and grandkids. And I think that's fitting. It's not a pleasant prospect, but it's probably something that might give us a chance to finally sacrifice for the rest of the country.
John, this has been an amazing interview. Please tell us about what you're doing right now and how everybody can follow your work.
Well, right now I run dollarcollapse.com, which is a site that covers all the stuff we talked about, updated continuously. So the idea is you tune in the morning, check it out, and you're brought up to speed on the gloom and doomy side of the world, because that's the beat there. So don't look for optimistic news, but look for the real things that are happening out there.
Realistic. John, thank you so much for taking the time to come on the show.
Thanks, Michelle.
Mr. John Rubino, expert financial analyst and the founder of the website dollarcollapse.com. For the Industry Experts panel, I'm Michelle Holliday at portfoliowealthglobal.com.